But right now, I'm just going to give a little bit of an intro here on what's going on in my sector, the oil and gas sector. We've had a really interesting run here recently, and a run that shows one big thing. Nobody can predict the future accurately at all. I'm going to tell you a lot about what my prognostications were in January of this year, and here it is, only 2 months, and a couple things I got right, and a couple things I got dead wrong. And we're kind of going to go through that. And I think one of the lessons here is that what's happening right now in the energy patch is that things are changing so quickly. Production is just ramping up at so many different formations that the pipeline infrastructure really can hardly keep up. And that's creating some unbelievable price differences around North America in oil and gas. You've probably seen in the last probably 6 to 8 weeks how natural gas prices have come way up. And they've basically almost doubled from 3 to 6. But because of different pipeline constraints, for example, in New England, in Boston, they were paying $100 an MCF for gas one day this winter. And they were regularly paying, on several occasions, over $60, $70 an MCF because of pipeline constraints. So all that activity and pricing creates a lot of different opportunities for investors and makes it really difficult for anybody to forecast really what's going to be happening in the future. So I'll just run through a few of the ideas that I've had for subscribers and just show you an example of that. So back in January, I said, okay, here's the sectors you want to be involved in. Ethanol, which is just oil made from corn. That's going to be a big sector simply because corn prices are low and oil prices are high, so that's simple. Heavy oil. Heavy oil always trades at a big discount to light oil, but this year I think we could actually see that turn around. Actually, I thought we could see that turn around until last week, and I'll explain why. But a lot more U.S. refinery capacity for heavy oil now. So I think that's going to be a great spot to be in the energy patch. I said refineries would be a great place to be because I expected the price of light oil to collapse. And that's still a slight possibility, and I'll explain that as we get through too, but that's been a big surprise this year. So if ethanol is one oddball commodity, condensate is another. Ethanol is down in the States. We now import all, the U.S. ethanol industry killed our industry, so we import all our ethanol now. But in Canada, we make a lot of condensate, and that's a very lucrative market. It's kind of an oddball niche market for energy, but basically almost every single Western Canadian gas producer produces some condensate. So I was saying that was the other place where people should be. So just quickly on ethanol, again, it's a very simple trade. The whole idea here is that you make the oil, high-octane oil, high-octane gasoline from corn, and so obviously if oil is up, which it is, and corn is down, which it is, it's a very profitable trade. So right now we're doing about ethanol is as much as 50 cents a gallon less than gasoline, which is providing huge incentive for refiners to use as much of it as possible. And because of the record corn crop in 2013, as I said, the corn price now is very low compared to oil, and this has been one of the biggest money makers of the last 4 months. We jumped on this bandwagon about a year ago, but then about 3 or 4 months ago, it really went into high gear as the new corn crop came in. So this trade has actually worked out very well. There's the price of ethanol these days, up about $2.23 a gallon. It was yesterday, and as you can see, it's had a big run since November. And this is all public domain stuff you can pull off the NASDAQ website. And that's the price of corn. As you can see, it's had a little bit of a rebound, but it's come down a lot in the last year. Basically, it was over $7 a year ago today, and now it's $4.50, and it's been as low as $4.20. So that sets up a very simple trade. And the corn crop was so huge that it would take an unbelievably dry, hot summer to turn this around. So I think ethanol is going to be one of the best places to be for the next couple of years. Well, I've been telling the subscribers that the stocks to buy here has been Green Plains. We bought the stock last year around $9, 26 today. And Pacific Ethanol doesn't make 1.1 billion gallons a year. Actually, Green Plains does. Pacific Ethanol is a junior that we got everybody into in November. And like I say, in Canada, there are no ethanol stocks. We import all our ethanol from the U.S. now. They completely killed our ethanol industry. And so, and those are the two stocks to go. And that's what happened to Pacific Ethanol literally just this week. In the last 3 months, it's quintupled, and it's actually still cheap. I think there's a great shot this stock's going to be $30 to $40 this year. So even though it's had a big jump, it's the ethanol industry right now is just making so much money. This company is cash flowing right now about close to $500,000 a day, and there's only 16 million shares out. So I'll give myself an A on that. We did the right thing on that story, and ethanol inventories are really low. And then we get into heavy oil, and this has had a change just literally in the last week. So, you know, it trades at quite a discount to light oil, and I've been thinking that because we have so much shale oil, light shale oil in North America, particularly in the States, that the light oil price was really going to collapse, and we're going to see heavy oil outperform fairly dramatically this year. And we're actually seeing more and more refineries switch to heavy oil, which makes no sense whatsoever in the States. It makes no sense at all. They should be going like mad over to light oil, but BP and their Whiting, Indiana refinery just spent well over a year and several $billion moving their 450,000 barrel a day refinery from 80% light to 80% heavy. So, but here's the wrinkle, and again, this is something that you could see coming in one way, but you wouldn't really have known it until it was announced. So just literally last week, they announced that, okay, so now you cannot use rail cars, which have been the savior of the Canadian oil industry for the last year and a half. If we weren't shipping oil by rail, Canadian heavy oil would be $40 a barrel right now. Like it just is we need rail so much because without Keystone, we need those rail cars shipping our oil down to the States. And we've increased our rail from zero, basically, 24 months ago to well over 300,000 barrels a day now, so down into the U.S. and the Gulf Coast. So, but just literally last week, they put in these new rail car restrictions that you're only going to be able to use rail cars built in 2011 or later. And I think that is going to have a very big impact on what we call the differential, which is if the light oil price is here and the heavy oil price is here, we call that gap the differential. And sometimes the differential is quite low, which is good for heavy oil, and sometimes it's quite high. And I think right now, because of these new restrictions, we got a possibility where heavy oil prices could see a much bigger differential through the rest of this year until the industry figures out what to do with it. The industry was really adaptable in figuring out how to use rail and really saved their Canadian bacon in a big way over the last 18 months. But now they've got a new wrinkle here, and they're going to have to figure out how to get around that as well. So I would say we get a B for that because those stocks have done okay, but nothing special. I also said this year that refineries should be a great investment. And again, the whole idea that we are producing so much light oil out of the shales that it would overwhelm the refinery complex. And so basically what's been happening down in the States is they've created all these pipelines from Cushing, Oklahoma, where all the oil is stored, down to Houston. And my theory is, look, that's just rearranging the deck chairs in the Titanic. So all you're doing is moving that log jam of oil from Cushing down to Houston. So the truth is going to be the proof is going to be in the pudding on this trade literally in a month. As soon as the polar vortex is over, which has created huge extra demand for both oil and gas over the last winter, way more than anyone ever expected. We've seen huge drawdowns in natural gas inventories, and oil demand's way up in North America because of this. At the end of March, early April, when temperatures, as they do every spring, get warmer, we're going to see whether this idea holds any water or not. So I got stopped out of my refinery trade this year already because oil's done so much better than I expected, and particularly light oil. So I'm giving myself a C on this one, but I'm still basically looking to see where this trade might work again, because if it is going to work, and I think it'll work big if it does work, it should happen late March, early April. And then condensate. So this is, condensate down in the ground is a gas, but when it comes up the wellbore, it condenses, hence the name condensate, into a liquid. And it's used to dilute heavy oil. It's what they call a very light oil, so it's on the scale of oil, it's about 50 API, so it's super, super light. Most Western Canadian light oil is around 37 API. And so it's got huge local demand, and it trades about $5 to $10 above WTI. So it is the most valuable hydrocarbon north of Cushing. And it has been another savior for the Western Canadian gas industry, because there's basically a two-tiered gas market in Canada now, those with condensate and those without condensate. Because gas prices still, even at $5, no one's making a lot of money. And the other natural gas liquids like propane, butane, don't have much pricing power. Ethane don't have much pricing power at all. So if you don't have condensate, you're really not a very happy camper in the gas patch right now. And that trade has actually worked out pretty well. Its price has stayed high because the demand for oil sands diluent has stayed very high. And they're trying to get more pipelines to get all the condensate in Texas to come up here, because the Eagle Ford in Texas produces a huge amount of condensate, and they don't know what to do with it. They hate it. They want to ship it to us, but they're having problems. I guess Prime Minister Harper should say that needs a prime ministerial permit. That's what he should do. And so basically, condensate, because it's a smaller molecule than oil, comes up much more prolifically. You get some huge wells, 3,000 barrels a day condensate you're seeing in some places, plus gas. So these wells are incredibly profitable. Condensate pays for the entire well cost. They get the gas for free. And with nat gas now, you can hedge that out at $4 all year long. It's a huge windfall for Canadian gas producers. So that trade has worked out. And I actually see, and I'll talk a little bit about gas in a minute, but I think gas is going to stay higher than people think this year for a couple of reasons. So I said the fifth sector here, it's a big wild card. We'll see what happens, is the LNG services stocks. And we've got a couple of them here today with Enterprise and Entrec. But we're kind of in a holding pattern right now. The BC government just came out with their tax regime for LNG, and the industry is doing their thing that they do, saying, oh, no, that's way too much, can't pay that. Oh, my God, geez, can't pay that. But they are going to pay that, and they're going to be happy to pay that. Everyone says, oh, you know, BC, you got to get going, you're going to miss the boat. They're not going to miss the boat. People keep saying, oh, there's all these other people out there doing it. There's nobody else out there doing it. Nobody. The amount of liquefaction being done in the world is actually declining right now. So, and the Japanese, the Chinese, the Taiwanese, and the Koreans, they all want diversity. They all want many different suppliers. They don't want to be beholden to anybody. So Australia is going to be coming on in the next year. That's a done deal. That's priced into the market. By the way, no one's going to make any money on Australian LNG. Their cost overruns were in the tens of billions of dollars. Nobody is making any money like Shell or Chevron. They're not making a nickel on Australian LNG. When you have a cost overrun of $20 billion and you got a 20-year life reserve, you got 20 years to make back $20 billion extra. Not going to happen. So, and when it comes down to us and the Americans, because really we are the only other people out there. There's us and the Americans. There's going to be some stuff in Africa, but it's going to be fairly small. The only other big sources of supply are us and the Americans. And who do the Asians like better? With apologies to all my friends from Minnesota and Maryland. So these service stocks are kind of treading near their year highs, and really they just need one of these shoes to drop, one of these final investment decisions, which I don't think is going to come till later this year. But even so, as soon as that happens, all these stocks are going to jump 20% that day. First final investment decision that gets done, all these stocks jump 20%. Okay, so what did I miss in January? Well, the light oil story was totally a big miss, and there was a couple of reasons for that. One was that I didn't foresee the Canadian dollar going from $1.03 to $1.11, which has been a huge cash flow windfall for Canadian oil producers. And of course, the polar vortex has just created this huge demand. I think it's funny we've given this winter a name. Like when I grew up in Stratford, just south of here in the 1970s, it was this cold every winter, every single winter. We never had any special name for it, except rotten. And so I did not buy any light oil stocks in tax loss season when I should have been, and I just wasn't a believer. And I have been so wrong, because those stocks have done absolutely fantastic. Companies like Tamarack Valley, you know, Mass's Manitowoc had a great run from $2 to almost $3, but I didn't buy any of them because I just wasn't a believer that light oil was going to do anything. In fact, I've always been waiting for the shoe to drop, and basically I'm going to throw the towel in on that trade idea if by the middle of April we haven't seen that happen. And so the other thing I missed, obviously, was natural gas. You know, we have been so good, particularly the Americans, at increasing supply. Probably anywhere from, well, a few years ago it was 6 or 7 BCF a day. The U.S. now produces about 67 billion cubic feet a day, and that's gone up over the last few years, 5, 4, 3, 2. So they've been very, very good. And this year, they're going to increase production by about 3 BCF a day to 70 billion cubic feet of gas a day. And at the same time, what we're seeing here is that storage levels have gone way, way down because of this cold winter. And so that has totally changed psychology in the market. Not only changed fundamentals, but I think quite importantly, it's changed psychology here. So as you can see, this comes from First Energy, and their little circles say where they think it's going to, where we're going to catch up on storage here later this year. But just to give an example, last summer, TransCanada got in a bit of a fight with the producers about tolls to get Western Canadian gas east. And the utilities in the east just said, screw you, we're not going to take your gas, and we'll just use what we got in inventory. And so they did that, and TransCanada ended up getting their way, and so they all had to make up. But the reality is that with this winter, that argument will never happen again. There will not be any utility in North America that is going to allow their gas inventories to deplete like Ontario and Quebec did this last summer, because everyone is worried about another repeat of this kind of winter again. And I think really the big game changer for gas isn't going to be LNG, it's going to be Mexico. U.S. gas exports to Mexico are going to increase 3 Bs a day this year, exactly the amount of the increase in production in the U.S. So to me that says we're going to have a balanced market, which we haven't seen for about 3 or 4 years. And going into that balanced market, we've actually got lower inventory levels. So I think nat gas is actually going to be a bit stronger this year than people think. And this time next year, I think it's very possible we could see $6, $7 gas here in Canada. Oh yes, and global cooling is coming. I'm actually going to be doing a big story on global cooling. It's here, it's going to be here for the next 20 years. And the garbage science that the climatologists have been feeding us through the media is going to get debunked very, very quickly.